Right now, as you watch this video, a small group of hedge funds have placed a $1 trillion bet on the safest asset in the world. They borrowed $50 for every $1 of their own money. Some borrowed $100 for everyone. They did this quietly through private agreements with the largest banks on Wall Street, using a strategy so complex that even most professional traders have never heard of it. And here is what should concern you. In March of 2020, this exact trade nearly collapsed the entire global financial system. The Federal Reserve had to step in and purchase over $1 trillion in Treasury bonds in a matter of weeks, just to stop the bleeding. The funds that made this bet were quietly bailed out. The public never knew. And now, 5 years later, the same trade is back. It is bigger than it has ever been. The same players are involved, the same risks exist, and almost nobody is talking about it. By the end of this video, you will understand exactly what the basis trade is, why it nearly destroyed the Treasury market once before, and why the conditions for a repeat are not just possible but mathematically inevitable. This is not speculation, this is not opinion. This is documented in Federal Reserve research papers, Securities and Exchange Commission testimony, and the exposed positions of the largest hedge funds in the world. Everything I am about to show you is publicly available. The question is why no one in mainstream financial media is connecting the dots. Let me start by explaining what the basis trade actually is, because understanding the mechanics is essential to understanding the danger. Treasury bonds are considered the safest investment on the planet. When you buy a Treasury bond, you are lending money to the United States government and they promise to pay you back with interest. Simple enough. But there is also a futures market for Treasury bonds. A futures contract is an agreement to buy or sell a Treasury bond at a specific price on a specific date in the future. In a perfectly efficient market, the price of the actual Treasury bond and the price of the futures contract should be almost identical. But they are not. There is always a small gap. Sometimes the futures contract trades slightly higher than the cash bond, sometimes slightly lower. This gap is called the basis. Now here's where it gets interesting. Hedge funds discovered that they could exploit this tiny gap by buying the actual Treasury bond and simultaneously selling the futures contract. When the futures contract expires, the two prices must converge. The gap closes. The hedge fund pockets the difference. The problem is that the gap is tiny. We are talking about fractions of a percent. To make real money on fractions of a percent, you need massive leverage. And this is where the danger begins. A hedge fund will buy $100 million worth of Treasury bonds. Then they take those bonds to a bank and use them as collateral for a loan. The bank gives them $98 million. The hedge fund takes that $98 million and buys more Treasury bonds. They take those bonds back to the bank, get another loan, buy more bonds. They repeat this process until they have built a position that is 50 times, sometimes 100 times, larger than their original capital. They are borrowing from banks every single day to maintain these positions. The loans are called repurchase agreements or repo, and they roll over daily. Every single day, the hedge fund must convince the bank to extend the loan for another 24 hours. In normal times, this works. Treasury bonds are safe. Banks are happy to lend against them. The hedge fund clips a small profit on the basis, magnified by enormous leverage, and everyone makes money. But what happens when times are not normal? What happens when something shocks the system? This has happened before. Let me show you the pattern. In 1998, a hedge fund called Long-Term Capital Management had built one of the most sophisticated trading operations in history. They employed Nobel Prize-winning economists. They used mathematical models that were considered unbreakable. And they were running the basis trade along with other arbitrage strategies at 25 times leverage. Then Russia defaulted on its debt. Nobody saw it coming. Global markets panicked. Investors fled to the safety of Treasury bonds. But LTCM was effectively short Treasuries through their arbitrage positions. As Treasury prices spiked, their losses mounted. At 25 times leverage, a 4% move against them would wipe out all their capital. The Federal Reserve had to organize an emergency bailout. 14 of the largest banks on Wall Street were brought into a room and essentially forced to rescue the fund. The fear was that if LTCM collapsed, the cascade of forced selling would bring down the entire financial system. That was with 25 times leverage and a few $1 billion at risk. Fast forward to March 2020. The world is shutting down, COVID is spreading, and the Treasury market, the most liquid market on earth, freezes. Hedge funds running the basis trade at 50 times leverage suddenly face a problem. The gap between Treasury bonds and futures is not converging. It is exploding. Banks that had been happy to lend against Treasury collateral start demanding more margin. They want more cash as a buffer against losses. Hedge funds do not have the cash. They are leveraged 50 to 1. So they start selling. They sell the Treasury bonds to raise cash to meet the margin calls. But everyone is selling at the same time. There are no buyers. Prices collapse further. More margin calls. More selling. The doom loop has begun. In the span of 2 weeks, the Federal Reserve purchased $360 billion in Treasury bonds in a single week. To put that in perspective, during the entire third round of quantitative easing in 2012, the Fed was buying $80 billion per month. In March 2020, they bought 4 times that amount in 7 days. They ultimately committed to buying unlimited quantities of treasuries to restore order. The basis trade funds were bailed out. They did not have to liquidate at the worst prices. The Fed absorbed the selling pressure. And then something remarkable happened. Everyone pretended it never occurred. The funds went right back to the same trade. Which brings us to April 2025. President Trump announces sweeping tariffs. Markets react violently. The 10-year Treasury yield spikes past 4.5% in a matter of days. 30-year yields break above 5% for the first time since the early 1980s. This is not normal price action. This is liquidation. The basis trade is unwinding again. Hedge funds are selling Treasury bonds to meet margin calls. Banks are pulling back from lending. The repo market is under stress. But this time, the Fed does not immediately intervene with massive purchases. They wait. They watch. And then something interesting happens. The market stabilizes. Not because the problem was solved, but because of a facility the Fed quietly created after 2020. It is called the Standing Repo Facility. And its existence changes everything about how we should understand the basis trade today. The Standing Repo Facility is essentially a prearranged bailout mechanism. It allows primary dealers and select financial institutions to borrow cash from the Federal Reserve using Treasury bonds as collateral. Overnight. On demand. At a set rate. The message to the market is clear. If you get in trouble, we will be there. You will not face the same liquidity crisis as March 2020. Keep trading. A senior official at the New York Federal Reserve gave a speech in May 2025 acknowledging that the basis trade is, and I quote, large, leveraged, and growing. But he argued that the standing facility reduces forced sale risk. In other words, the Fed knows the trade is dangerous. They know it nearly broke the system once. And their solution is not to reduce the risk, but to promise they will bail it out if things go wrong. This is the part of the story that should concern you most. The 10 largest hedge funds in America have more than doubled their repo borrowing in just 2 years. They went from under $700 billion to over $1.4 trillion in borrowed money. The basis trade is not shrinking. It is expanding. And it is expanding precisely because the participants believe the Fed will never let them fail. Now, you might be thinking, if the Fed is willing to backstop the trade, what is the problem? The problem is that backstopping requires the Fed to buy Treasury bonds. And buying Treasury bonds in large quantities is inflationary. It is money creation. In 2020, the Fed could justify unlimited bond purchases because inflation was below target and the economy was collapsing. They needed to stimulate. But what happens if the basis trade blows up when inflation is running at 3 or 4%? What happens if the Fed faces a choice between saving the Treasury market and maintaining price stability? This is not a hypothetical. The research is clear on this. A paper from the Dallas Federal Reserve published in 2025 found that the basis trade is far more sensitive to intermediation capacity than to interest rate changes. What does that mean? It means the trade does not blow up because rates move. It blows up when banks stop lending. And banks stop lending when they get scared, when volatility spikes, when their own balance sheets come under pressure, when regulators start asking questions. The trigger is not predictable, but the outcome is, every single time leverage this extreme meets a liquidity shock, the same thing happens. Forced selling, price dislocations, systemic stress. The Securities and Exchange Commission has been asking questions. Chair Gary Gensler has publicly stated that there is risk in our capital markets from relatively low margin or even zero margin funding to large macro hedge funds. Zero margin funding. That means some of these positions are being put on with essentially no money down. The bank lends against Treasury collateral at near 100% of value. The hedge fund puts up almost nothing, and they lever that nothing into billions of dollars in positions. There is a reform coming. The SEC passed a rule in 2023 mandating more central clearing of Treasury and repo transactions. Central clearing means trades go through a clearinghouse that sits between buyers and sellers, reducing counterparty risk and improving transparency. But implementation has been delayed. The deadlines now stretch into late 2026 and 2027. The industry pushed back. The infrastructure is not ready. And so the basis trade continues to operate in the shadows of bilateral agreements that regulators cannot fully see. Here's what the pattern tells us. Stage 1 is the foundation. A strategy emerges that generates consistent profits with apparent safety. Capital floods in. Stage 2 is overextension. Leverage increases. Risk controls loosen. Participants believe they have found a perpetual money machine. Stage 3 is the silent exodus. Smart money begins to hedge. Regulators issue warnings that go unheeded. Emergency facilities are created just in case. And stage 4 is collapse. A shock triggers forced liquidation. The facade of safety evaporates. Those without a backstop are destroyed. Those with a backstop survive, but at enormous cost to the system. We are in stage 3. The Fed has built the standing repo facility. The New York Fed is publicly acknowledging the risks while simultaneously reassuring markets. Position sizes are at all-time highs. Reform is delayed, and the entire edifice rests on a single assumption: that when the next shock comes, the Fed will be willing and able to absorb unlimited Treasury selling without consequence. The pattern does not care about assumptions. The pattern does not care about Nobel Prize winners or sophisticated models or assurances from central bankers. The pattern has repeated 3 times now: LTCM in 1998, the COVID crash in 2020, the tariff shock in 2025. Each time the trade got bigger, each time the leverage got higher, each time the bailout got larger, and each time after the crisis passed, everyone went right back to doing the same thing. The question is not whether the basis trade will blow up again. The question is what happens when it does. Does the Fed monetize trillions more in Treasury debt, reigniting inflation? Do they let hedge funds fail and risk a cascade through the banking system? Or do they find some middle path that satisfies no one and solves nothing? $1 trillion in leveraged bets, 50 to 100 times leverage, daily funding that can be pulled at any moment, emergency facilities standing by, and a market structure so opaque that even regulators admit they cannot see all the positions. This is not stability. This is the illusion of stability maintained by the implicit promise of infinite bailouts. And the history of finance teaches us one lesson above all others. When something cannot go on forever, it stops, usually at the worst possible moment, usually when everyone has convinced themselves that this time is different.